Hello and welcome to Policy Watch, a show that looks at the top business and economic news of the week, its context, its relevance and impact. I'm Govindraj, Ethiraj. The Chinese stock markets have crashed more than 30% in a month now, triggering fears of a global financial shock, potentially worse than the impact of Greece defaulting on its debt. Now, while analysts say the problem is contained to Chinese small investors and there is little institutional impact, the market meltdown could affect Chinese companies and thus the economy. The more important question, therefore, is it a threat or an opportunity for India? Joining me to discuss that here are K.K.Mital, Vice President, Venus Assets Finance, Professor B.P. Bhattacharya, Professor at the NIFPPP, and we're also joined by Rajesh Mahapatra, Executive Editor at the Hindustan Times. Gentlemen, thank you very much for joining us. Mr. Mittal, let me begin with you. We've just about got over Greece, and that shock is still hanging in the air, and we are suddenly confronted with a new equation or a new phenomenon, which is China, and the stocks seem to have crashed out of nowhere. Right? Is the worst still to come when it comes to Indian stocks in Indian markets, or are we still at the beginning?
To begin with Greece, Greece is a very small economy in the entire Eurozone, contributing 2% to GDP of Eurozone. If we consider China, China is a big economy, almost $10 trillion economy. If we look into the journey of Chinese stock market, it went up more than 150%. A $3 trillion of market cap went up to almost more than $9 trillion of market cap.
And so it's lost $3 trillion as well.
Yeah. So it has already lost $3 trillion, in fact. So the market has corrected the way it has gone up. The journey was very, very sharp. And so the profit taking is very, very sharp. We must understand that Chinese markets are driven by retail investor, whereas the participation into Indian market is minimal, just 3.5–4% of retail. But Chinese market is largely more than 80% retail driven. So that's the impact. When everybody is buying, everybody went on buying into stocks. And now everybody is selling.
And you also had a phenomenon of margin financing, which obviously triggered some of the problems.
In fact, the margin financing, the bank entering into the stock market through the route of wealth management trusts. So this is what the problem is.
Right. Okay. Professor, let me come to you. So was this a problem in some ways waiting to happen?
Yes. But before I answer you, let me make a small correction. I am not a professor in NIPFP.
Okay.
I was professor in Institute of Economic Growth, Indian Institute of Management, professor and vice chancellor at JNU.
Right.
Okay. Yes, it was very much expected. You see, no country in the world has ever maintained 10% plus growth for more than 3 decades. Japan, South Korea, Taiwan, they all had peaks and then melted. We are all expecting this. Chinese per capita GDP is 5,000 plus. Time for it to start what we call the phase of decreasing returns to scale. And accordingly, stock market should have anticipated, slowly adjusted. Unfortunately, there's a discrepancy between fundamentals and stock market expectation. Stock market people still thought, oh, economy will grow. But when signs of deceleration were visible in fundamentals, somehow they were ignored by the stock market, resulting in this total mismatch. Chinese economy now going to be between 6 and 7%. Market, therefore, had no business to go like that.
Right. But markets always work like that.
That's
I mean, while the point is taken that the economy was slowing down and the markets were zooming, but markets also tend to behave strangely. Mr. Mittal?
Yeah, definitely. You know, now, as in today, the IMF has given estimation of GDP growth of China and India. India is going to grow 7.5%. China 6.8 this year and maybe 6.5 next year. So definitely the slowdown of Chinese economy is already on the card. It is slowing down. The metal prices, the commodity prices globally are coming down just because of slack of demand from China.
And that really brings us to our question about, is this an opportunity for India or whether it was a threat?
Yeah, definitely yes.
Yeah, I think on the face of it, you could say, you know, China's loss could be India's gain. But it's not that straightforward, because in the world that we live in today, where the interdependencies are so complex, let's try to see how the China and what is happening in China, how it's sort of going to cascade and mediate through various layers. There is something happening in the China's financial market that through the Asian financial market, through the global finance, would have a bearing or impact, positive, negative, on the Indian market. So that's one aspect. Then there is something happening in China in the financial market, which no matter what we say and what kind of denial we might be in, is going to have a definitive bearing not only on the real economy of China, but also elsewhere in the world, because China is not a small country; it's the second largest economy.
Right, and I think that's an important question, which we must understand first in the Chinese context, and then whether this could impact us. Professor, let me put that to you: is the real economy impact likely to be greater than what we perhaps think? What I'm trying to say is that the stock markets have crashed, lost $3 trillion in capital, market value. People are obviously hurt. Their ability to raise finances are hurt. Will that affect the real economy?
You mean China's real economy?
Yeah.
Yes, there will be less flow of capital into China. Slowly now, the financial market will adjust the high pitch with which they were bringing capital to China. But it will be good for China. They were overheating. So there will be more moderation, realistic assessment. China overinvested too much, created too much capacity. So that will be good for China. What will also happen? China might increase consumption. And that will reduce its pressure on export drive all over the world. But Chinese, sometimes unpredictable. They may still say, no, we don't want our people to consume. Let's export more. That mercantilist philosophy of accumulating $4 trillion reserve, we don't know when they will stop. But if they behave rationally, they will now allow more consumption in China and not so much export abroad.
Right. So, Mr. Mital, let me try and put this in context. Now, our markets in India have been on a weak footing in any case. Whether it was Greece earlier, whether it's China now, assuming the China impact is limited, are we still looking at a situation where markets might again take a hit if something were to go wrong?
See, I would...
at the international front,
yeah. On the international front, I will just pick up 3 things from the Chinese economy. One is the real estate sector. The first suffering in China is from real estate sector. We call it ghost towns, no takers. Then second is banking and financial institutions of China. They are facing problem. And third, now the stock market. Definitely the impact is easing out of commodity prices globally. Crude, we know, has come down to in the range of $55. All other commodities like metals and all are coming down slowly. Now, as far as India is concerned, Indian stock market, the composition wise, are not as risky as Chinese market are, in fact. If we look into the weightage of financial sector and compare it with the Chinese financial sector, whether FMCG, pharmaceutical, IT companies, so our
So you're saying you've got more solid blue chips?
Yeah, we have more solid composition, in fact, in comparison to China. China's cyclical and financial. The majority is metal and financial.
Okay.
So our composition is less in comparison to China. So we are less riskier markets.
Right. So you're saying metal and financial stocks, which obviously have taken a hit in this downswing, are not so prevalent, at least in India, as perhaps other stocks which are doing well.
Right.
Rajesh, lessons to take away.
No, I think, I just want to come back to this. I think what happens to the Indian market depends a lot on how the global investors perceive this problem. If they look at it as an Asian phenomenon, and if the contagion effect is really going to get onto Hong Kong, Australia, the miners are going to be affected in Australia, are getting affected, then, you may have some impact on FII inflows into the Indian market. If the global investor sees this as a Chinese problem, and sees the Indian financial market to be kind of insulated, then you may see actually it as an India's gain, because if you look at the trends after 2 months of withdrawals from the Indian market, in the first 8 days, FIIs have actually brought back roughly about $600 million into it. So that's one benefit that India stands to have. The second thing is, the Chinese government will still try to prop up the GDP figures. And no matter how much we criticize, the new GDP estimates in India, I think by far it will be settled that India will now emerge as the fastest growing major economy in the world. And that has a bearing on how investors and the global finance looks at India. So that's one aspect. The second aspect, which I want to come back to this commodities prices, I think this is a great relief in many ways for the government of Narendra Modi. You're going to see significant softening of global commodity prices, especially those on which we are significantly dependent.
Including
now,
oil. Yeah.
Oil, copper, we import
steel.
Fertilizer. Nobody is talking about it, they are all softening. But here lies the catch. If the global investor sees this as an Asian phenomenon and doesn't warm up to the Indian market, your rupee is going to come under pressure. The dollar is already firming up, and the Fed has still not started tightening. So the dollar is going to firm up further, and whatever gains you might see in terms of softening of commodity prices may stand to get neutralized.
Right. Okay. So we're running out of time. Let's get a quick wrap up. So what's the prognosis ahead, Mr. Mital? Let me begin with you.
See, let me start with the weakening of commodity prices, which is in favor of India to a very, very large extent. It's a phenomenal opportunity.
And you're saying this will play out in coming weeks and months and so on.
If we look into the crude prices, they're so favorable that we are now on zero subsidy. So we are saving on that. We are saving on gas subsidy. We are going to save on food subsidy. We are saving on fertilizer subsidy, which can be used for infrastructure, investment purposes.
Right. So you're saying overall lowering of prices is good for India?
Yeah,
so
I think it's a boom for Indian economy. As on date, we need to remove hurdles. That's the issue.
Okay. Make it easy to do business. Okay. Professor Bhattacharya, last question. What is the biggest lesson for us in this, and what do you see happening ahead?
Not to allow stock market to get into such irrational boom. In that respect, I should say our Governor Reserve Bank is frequently giving warning. This should be adhered to, because we also have a tendency sometimes to get into the hype mood. Yes, we are now growing fastest, but 7.5. We can maximum expect 8, 8.5, and not dream. We are now moving into Chinese 10% for next 2 decades, 3 decades. So if you behave rationally, rational investment, steady state growth, we have a very bright prospect. But if the hype sets in, I'll ask both the government and Reserve Bank to be very carefully monitoring situation, have a check on hype.
Okay. When you say hype, you mean stock market hype?
As well as, say, real estate, as well as overall growth, giving too high optimistic picture for indirect investment growth and using more investment attracting, and when they will find no market.
Right.
This typically happens.
Right. Okay. So take care in how you project India as an investment opportunity, as well as, of course, manage the markets more carefully. That's the lesson from China, and we need to go in for a break. But coming up on the other side, we look at the new steel tariffs that have been introduced, import tariffs. The big question that we are asking is this protection coming back, and in a way, a backtracking of economic reform? Stay with us. Welcome back to Policy Watch. The government recently raised import tariffs on steel, protecting domestic steel makers from falling steel prices globally. Analysts quoted by business papers say bottom lines are expected to benefit. So the larger question we're asking is Indian industry fundamentally unprepared for competition, and could a move like this mean more efficiency in the system, since it could hurt consumers in the longer term? Joining me to discuss that are two gentlemen, B.B. Bhattacharya, former Vice Chancellor JNU and Professor of Economics, and also S.K. Sarkar, who's associated with both ASSOCHAM and PhD chambers, the industry bodies. Gentlemen, thank you very much for joining us. Mr. Sarkar, let me begin with you. This seems to be a move which in some ways almost sounds like a backtracking of economic reforms, right? Protecting some parts of industry at the cost of others.
It is. And if you ask the steel industry today, they're still saying that this rate hike is not good enough. They're saying that 7.5% is obviously not, and they are actually targeting about 15%. Now, when you have that kind of a protection, so actually I would feel that the Make in India concept really goes for a 6. It doesn't really work when you have that kind of protection. And another thing which I think we need to be very careful about is that the special grade steels, like you have the cold rolled strips of the automobiles, those will always be imported. I mean, those, we are not in that grade, that special grade.
Right.
We don't make that special grade at all. And even today, we are exporting iron ore to Korea, South Korea, and Japan, and we do get their higher grade steels, which still keep coming to us. This protection, if any, will give protection only against the cheap imports which come from China. And so that is where we stand. Right. And how far that can succeed is I mean, we're not really raising our levels by these kind of policies that we have.
Okay, Professor, this is something that you had in some ways foreseen.
See, 2011, Ministry of Steel, Government of India appointed a committee with me as a chairman to look at demand and supply of steel in the next 20 years. So we had representatives from both public and private sectors, and I took their statistics data and then looked at it globally. And I came to a firm conclusion. China, in the pretext of Beijing Olympic 2008, overexpanded its infrastructure, created a huge capacity, and I came to a conclusion immediately, 300 million tons plus steel, China won't have sustainable demand as soon as Chinese economy slows down, and which is expected. They were in double digit for 3 decades. Now time for China, slow down. So I said, start making improvement in efficiency technology, Indian steel mill, beginning 2012 itself. Don't wait. At that time, no steel industry were feeling the pinch. So I said, no, you are going to feel the pinch very soon. Prepare yourself from now. But like many other policies of India, unfortunately, we will wait till the last. Now Chinese growth has decelerated. China's infrastructure building has completely slowed down. And huge talk of infrastructure already built steel, 300 million tons plus a year. China is going to find market. India will be their target number 1 because India is going to build infrastructure. Time to time, we say we have to invest so many billions.
And therefore, prices will obviously remain low because there's a glut in the market. Yes. But the larger question here, and let me come to you, Mr. Sarkar, are you getting a sense that we are going backward in some ways as industry? Because the whole idea was that, we're going to encourage more efficiency. Given that we also have a weak rupee, the only way you can counter that is if you have more productivity and more efficiency, whereas we seem to be going in the other direction.
Well, do we have a weak rupee? I mean, I think we'll have a weaker rupee after some time. Okay. I think the rupee still is quite overvalued. And if you look at the steel production as a whole of the global, of the world, it is, China makes about something like 50 to 60% of that whole. And we are number 3. And number 3, we just overtaken USA. And we are at 300 million tons, which is nothing as compared to what China does. China is about 900 no, I'm sorry, it's about 1,100 million tons that they make. Now, if they are doing that kind of a production, we are not matching that by any standards. And if we are not doing that, so obviously we are decelerating. We are not putting our steps forward to the extent that we should. And that is where I think, and steel somehow has to be the backbone of any manufacturing.
Sure. But the larger question I'm asking is, I mean, is this a good sign or is this a bad sign? I mean, first let's understand that.
Good sign of the. Are you talking about the import tariffs or are you?
Yeah, no. I mean, the fact that import tariffs have been imposed, is that a good sign when it comes to an economy which is going forward?
No, I think that's a wrong signal being given because that, as I said, that the concept of make in India is, I think, will be taking a beating if we.
But the apologists would argue that make in India gets a boost up because you're in some ways protecting Indian companies from imports.
Yes, but you are losing out on your competitiveness. You're losing out on your efficiencies. You're losing out on your skills. You're losing out on, as I said...
But could there also be an argument that because China is sitting with so much capacity, in some ways it's dumping on Indian markets or markets like India?
Well, that is where the real challenge comes. If you are making like I talked about higher grade steel, if you are making that, so the value addition of course becomes more there. Are we looking at that kind of a situation? We are not. We're just making steel just for.
We're talking about hot rolled coils and higher up.
So we're not going to the CR category at all.
Okay, got it. Yes,
what
Professor.
I expect, Chinese will quickly start steel used light consumer goods. So if they find that dumping of steel is difficult because of the tariff, which India cannot do, by the way, we have entered into WTO agreement saying manufactured goods not more than 10%. 15% China is going to protest.
Yeah.
But assuming that we carry on for some time, what China will do, switch over to steel making utensils gadgets and others cheaper, and those things India has not yet imposed tariffs. So Make in India will get a dent, not necessarily from steel, but steel used all the manufacturing products, China will start bringing them cheaper in India.
Right, and that's the point that downstream manufacturers are also making, which is saying that their input cost goes up, as it would in any such situation. So what is the largest signal that we are sending here, Professor?
The largest signal is there is no alternative to improving efficiency and technology in Indian steel.
Okay, and the question therefore is, if it's steel today, could it be something else tomorrow?
Yes, down the stream, steel is a basic inputs for all industrial goods. So Make in India is feasible, provided we stress immediately efficiency, productivity and skilled labor. This kind of import tariff is a temporary relief. You can't sustain it in the long run. Sooner or later you have to remove it. So you can't sustain and Make in India. It's like in the old 1950s, import substitution. And as soon as competition comes, you crumble. So that's the artificial support.
Right. So Professor is saying that this is an aberration. I mean, but do you agree, Mr. Sarkar? I mean, or could this actually could this spread to other industries as well?
One has to agree with this, because there's and I think Professor Saab talked about skill. And unfortunately, the skill factor in India is missing totally. So the skilled labor, if we could garner that, and if we could bring that up, that would solve a lot of problems. And we should accept anything as a challenge. I mean, we cannot say today that just because the world prices are crumbling, so we must get some protection against that. You see, this chest thumping must stop. If you keep doing this, you will never be able to stand on your legs tomorrow. Okay. So that's the issue has to be that please try and think of tomorrow and try and build up. And you see, you will have to think of what are the manufacturing ideas which are coming in, let's say tomorrow. So you will have to keep your steel production in step with that. So that is the challenge which we must accept, rather than rolling out what we just have. Right. So that's not the
right. So think of good sort of more innovation in manufacturing.
Absolutely, the innovative factor
and
has
automation,
to
of course. That's the other input there. So the other question is, if we were to see duties being where they are. In some ways, are we also helping companies clean up their balance sheets? Because that's the other big challenge that particularly large companies face. They have a lot of debt sitting on their balance sheets.
Well, that's the universal truth. You can't run away from it. If you look at the interest coverage ratios of our bigger companies, they're abysmal. I mean, it's not. I think they're facing a lot of problems. The margins are getting squeezed, but. If I have got into a problem, I don't expect the government to help me out of it. It is my business. I need to perk myself up and come back with some innovative products which would help me to get over that problem. Yes, the debts do exist, and the debts are in a very large in fact. And yes, I would also say this in favor of the steel companies, is that the interest rates continue to be very high today vis-a-vis the world figures. 7.25% is not the right rate today. China has 4.85 now. And
you're talking about bank rate.
So
not the actual borrowing.
And the actual rates, so the base rates. So based on those rates, the rates are fixed. So if we look at those kind of rates, I do not think that you can expect the steel companies to come out the morass that they are in today. And one has to be a little more innovative.
Right. Professor, the sort of forward lesson for us, and how do we deal with this in future?
Well, temporarily, we should get a little relief, but it should be time-bound, specific, message clearly given to industry. I'm giving you temporary relief. Meanwhile, correct your business, come up to the international standard. If Mittal could survive Chinese steel producing from Eastern Europe, why not you? So you put your house in order. I'm giving you a temporary relief. It should not be a signal that, okay, henceforward I am putting a Himalayan wall. No, that should not be allowed.
Okay, and finally...
Can I leave you with a question? I mean, my point here is that why did we raise the import tariffs? Rather, should we not have looked at the interest rates and brought them down? Okay. Because that would have helped the nation as a whole and the steel industry would have benefited, because without steel, you cannot think of manufacturing as a whole.
Yeah, last word, yes.
One caveat. With the Greek tragedy looming around, interest rate is going to harden all over the world. And if we raise interest rate very big way, lower in a very big way, there is a chance of flight of capital from India. And that's what the Governor Reserve Bank repeatedly warning. Industry somehow has not been in the same page with him. But I think Governor Reserve Bank is cautious. And we should be careful tampering with the interest rate too much at this stage. Let's wait, see the euro market stable, and then think of.
Yes, but I would just say that give a signal. Give a signal. Let's say 100 basis points.
So anyway, the point is taken. I think what you're saying is try and address it financially as well, and not just by way of tariffs and so on.
India is such a huge domestic market. I think people would not be able to ignore India as a whole.
Right.
Can the world do that?
And that's a good note to end on. Thank you so much. We've run out of time. We'll be back on Policy Watch next week, same time. Thanks for watching.